I review a lot of ETFs on this channel, but it's been over 2 years since I've covered my absolute favorite, VGT. And I'll be honest, I'm a little biased here. VGT has been the biggest reason I've outperformed the S&P 500 by more than $200,000 over the past 15 years. My average cost basis is sitting around $228 per share, and I've been a long-time believer in tech, in the past, in the present, and especially in the future. But being a tech bull doesn't mean we just go all in. In this video, I'm going to walk you through the good, the great, and the downright awesome parts of VGT. And just as importantly, who it's for and how much of your portfolio might make sense here. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. You are required to do one of these 3 things if you get value from these videos. You can tap that like button, you can join the channel membership, or you can rate my cool factor on a scale of 1 to 10 in the comments. And for those of you out there that have been looking for a great deal on the best tool to research stocks and ETFs, track your portfolio, and all of that good stuff that you see in every single video I make, Seeking Alpha is having its once per year Black Friday sale. Right now, new and returning members can lock in a full year of premium, the service I use, for $239 a year. So get out there and snag your offer. It does support the channel, but most importantly, it supports your pocketbook. You know what time it is. Let's grow. VGT Basics. VGT is the Vanguard Information Technology ETF. And as the name implies, it focuses entirely on the technology sector. According to Vanguard, the fund tracks a benchmark index that measures the performance of the US tech sector. It's passively managed using full replication when possible, and it holds companies that serve the electronics, semiconductors, and computer industries. Now, one thing that people notice right away is what isn't in VGT. You won't find Tesla, Amazon, Meta, or Google here. Not because they aren't tech-like companies, but because they're officially classified outside the information technology sector. But VGT still holds over 300 companies with exposure to large, mid, and small cap tech. And because it's market cap weighted, it naturally captures the upside of booming companies as they grow. We'll dig deeper into that and why it matters in a later section. And a quick miscellaneous update, Vanguard reduced the expense ratio from 10 basis points down to 9 basis points on February 1st, 2025. That covers the basics. Let's dive deeper. Key metrics. Let's get this guy off the screen because we have a lot to cover. We're going to look at the key metrics of VGT and then compare its total returns to some of the best growth ETFs out there. As always, we're using Seeking Alpha to do our stock and ETF research here. And I've pulled up VGT, the Vanguard Information Technology ETF. And the market's open right now, so you'll see this bounce around a little bit. But you can see that VGT is over $750 per share, quite a bit above my $228 cost basis. And starting here on the summary tab, this is where I look at 2 important factors of an ETF that I'm researching. And really there's 3, but we won't waste time with the third, and I'll explain that. I come down here and see that the expense ratio is at that new 9 basis points instead of 10. They're both razor thin low, and it's hard to find a fund this effective at these low rates. So we love that. Keep that money in your pocket. And then the fund assets under management. Wow, I haven't looked at this in a while. $138 billion. I guess I'm not the only one that owns this. Huh, go figure. But this thing clearly has very low spreads. It's liquid and it's not going anywhere. And then the third one, usually I scroll down and confirm that an ETF that I'm researching is based on a passive index. We already covered that, so I won't waste our time here. But that's an important one because I love passively managed ETFs. And now we're out here on the holdings breakdown, and we have a little more than usual to talk about here. Now up on the top section, there's not a ton going on. We're 98% technology. But where I want to get into a little more depth is the top 10 holdings. Now this is my nice little I told you so if you've been around the channel for a couple years. I last reviewed VGT over 2 years ago, and at the time, Apple and Microsoft were over 40% of the weighting. I think 42, somewhere in there. They were in the low 20s each. And I had a lot of comments saying I would never buy a fund that's so top heavy. And I was trying to explain with a passively managed market cap fund, it's a lot like VU. Yes, you can be overweight. Of course, if a company falls, it's going to hurt as it weighs down. But my main counterpoint with technology as a whole is that when a company, and I even said this last video, when a company shoots up, you'll capture those gains in real time as it does its thing, a la NVIDIA. It was, down here with like the Broadcoms and the Oracles here. At the time, Apple, Microsoft were up there. And I was trying to say, you won't necessarily lose value when the weights shift. As soon as another company takes off, Apple, Microsoft, while still performing solidly, Apple's had its up and downs, Microsoft's been great, will weight down naturally. And that's the beauty of this. It's not as if you hold 40% Apple and Microsoft in your individual stock account. That's not how this works. That's where that 9 basis points is a steal of a deal. Much like the 3 basis points to own VU, the S&P 500, it does the same logic. It takes care of this thing real time. As companies go bankrupt or fall out of the index, specifically to VU, it gets rid of them. And when companies shoot up and start kicking butt like NVIDIA lately, all of a sudden you're 17% NVIDIA and only in the 13 percentiles of Apple, Microsoft, all while crushing the market. So my point is, it's not dangerous overlap if you believe in tech as a whole. These things will jockey for position and shift around based on their market. And so I'll quickly say NVIDIA is the big dog now at 17, Apple and Microsoft, they're at 13, and then Broadcom's taken a nice little share of the allocation at 4.5. That's good to see. And then you end with Oracle, Palantir, Cisco Systems, AMD, IBM, and Salesforce. So all these recognizable known names in the tech space. And we're going to jump right over to our favorite tab with growth ETFs, and that's the charting tab, of course. And I've pulled up some of our favorites here in the growth categories. And then, of course, I always like to throw the market in too. It's obviously different, but it's good to see how the ETF of the day compares to the market. And we start with year to date. And again, this is set to total return, so it is including dividends. I'll quickly run through the competition. We have VGT, and then XLK is large tech only, so it's very VGT-like. VGT is much akin to VTI as XLK is to VU. So this is just your big boys, and this is all tech. And then, of course, and I just had to change this to QQQ because it has the history instead of QQQM, but I have my favorite multi-sector growth ETFs with QQQ and SCHG. And then VUG is a very solid, long-standing performer. And then, of course, we throw in the market. That's running through the competition here. And starting with year to date, you can see that the tech bros have outperformed the multi-sector growth ETFs by a little bit. And then VU is right in the mix with these guys, right there with SCHG. But VGT has fallen slightly short of its big brother. And then 1 year will be much more of the same, of course. QQQ does catch up a little, same with VUG. But year to date's getting pretty close to 1 year at this point. And VGT and XLK both come in at 20%. Now it gets more interesting at 3 years. VGT is slightly outpacing its big brother XLK at 123.5 to 121. QQQ very solid at 113, but trailing its competition of SCHG at 118 and VUG at 115. Good to see that one in the mix here. And then they all start to outpace the market here at 75. Now 5 years gives us even more. And XLK takes the lead here at 143 to 134 over VGT. They're both still ahead of the multi-sector ones. It looks like SCHG comes in third here at 114, QQQ at 111, and VUG at 105. And actually the market hanging tough with the big boys at 97. And really this is a great 5-year run for all these. This is fantastic on our returns. We've been very lucky. And then in this video, I'm just going to go out 10 years. Sometimes I go out more in these because some of these guys are a lot older. But for the sake of this one, we'll keep it moving. VGT does take the crown at 639%. XLK comes in at 628, so it falls about 11% shy of VGT over the decade. The Qs runs away with the multi-sector crown at 473 to SCHG's 410 and VUG's 379. So everything's been fantastic, but QQQ has been the big dog here. And then the market, it looks hilariously low here at 283, but for perspective, this has truly been incredible returns. If you get 283% on your investments every decade, you will very quickly hit the 7 figures club because of compound interest. I hope this continues for all of us. But back to this video, VGT is the champion. Now let's take a step back and see how VGT has stacked up against the overall market. Backtest versus the market. We just saw how VGT stacks up against the big growth ETFs out there. But for this section, I want to take a different angle. A lot of people say the simplest approach is to invest in the market with something like VOO or VTI or VT if you want global exposure. And I agree with that. You can't go wrong owning the market. But for fun, let's see what would have happened had you owned VGT instead. To get to the bottom of this, we're out here on Portfolio Visualizer, my favorite site for backtests. And I am a paid member of this thing, but it's very expensive at $360 a year. Trying to get an affiliate link to hook you guys up with savings, but I haven't had a response yet. And you can see we're keeping it very simple today. Portfolio 1, VGT. You can see it's 100% VGT down here. Portfolio 2, SPY. And you can see it's 100% here. And if you're wondering why SPY instead of VOO, because I usually use VOO for the S&P 500, it's just to get more history. SPY is older and that'll allow us to grab more years. The returns are a rounding error apart. And for the scenario here on the settings, we're going to pull as much as we can. So 1985, sure, that's the oldest, to 2025. I think it'll start in 2005, if I'm not mistaken. So we'll have 20 years and change. Include year to date, yes. So we'll get what's happened this year so far. We're just starting with 100,000 and contributing 2,000 a month to do a aggressive but realistic scenario here. Nothing crazy. And their monthly contributions, as I mentioned, rebalancing doesn't matter. There's only one holding. Reinvest dividends, of course, and display income, sure. And we're going to hit analyze portfolio. Okay, and it did pull from 1/1/2005 through November 13th when I'm recording this, a little early because I'll be in Portland for a couple Blazer games this coming week. Go Blazers 2025. So that's just over 20 years. Which gives us a great sample size of what goes on over long periods of time. Oh my gosh, I have not seen this yet, but we're starting out here at performance summary. And wow, now I see how I've beaten the market over the years. VGT with that $10,000 and $2,000 of contributions a month for just over 20 years ends at $4,880,000 to the market's $2,360,000. Over double the ending balance, which is extra crazy because it's not like we have some unrealistic lump sum and let it sit there. This is like realistic dollar cost averaging in, so it kind of nerfs the returns of both. That is wild. You see the standard deviation's a lot higher with VGT. You're going to be up and down with more extremes. Better higher, you would expect that. A worse bad year, you would also expect that. And then these higher risk adjusted returns, all this makes sense here. This is one thing I like to point out. The portfolio growth isn't as extreme as you might think. I feel like people get caught up with investments being completely different from one another, but generally speaking, when the market goes up, growth and value, and thus the market, go up. And generally speaking, when it goes down, they go down. It's just the extremities that change. You know, the downs are going to hurt VGT more than they hurt VOO, and the ups will help them more. But I always find it remarkable how well these track when you zoom out. And these annual returns probably tell that a better story. Not sure why I spent our time up there. But you can see the blue bar is VGT, and the green bar is SPY, and they coincide fairly well with one another. VGT will shoot way up like this, but it will also shoot way down like 08 and 2022. But for the most part, they do the same thing, quote unquote, just at different levels. So if you have lots of years to be in this game, that's why growth does so well, even with the crashes. Whereas if you're retired, this crash right here really hurts, especially if it's early in the sequence of returns. That's why I'm a big advocate of dividends and not selling shares in retirement. But that's for a different video. On the trailing returns here, when we look at the full time frame, oh wow, this is incredible. VGT is up 15.5% on average compounded annually, whereas the market's up a very solid, and you might say very nice, 10.69%. And zooming into the last decade here, oh man, that's stupid. 23% annualized return for VGT to the market's incredible 14.5%. That's not shabby at all. The historical average over the last 100 years is just over 10%, probably about right here, just under 10.2-ish. So the 10 years looking great. The 5 years, same story, 22.5 to 17.5. Wow. And then on the 3 year, okay, this is just, I look at this stuff all the time, but I guess the windows are always shifting. Goodness gracious, 35% to the markets, 22.5. No wonder every investor's making boatloads of money. How do we screw this up? And then the last year, it looks like 36.8 to 21.4. Just amazing returns across the board. And I will say, a correction is very likely coming, and that's where the jokes, I say that in quotes, like SCHG and even SPY compared to VGT. This thing only goes up, easy clap. Well, it won't always be so easy, so I still recommend balance. Okay, it's awesome, we all get it. But does that mean that everyone should load up the truck on VGT? Not exactly. Portfolio fit. I think VGT can be a great fit for investors of almost any age, but your allocation will rely on 3 primary factors: your years from retirement, your current portfolio mix, and then of course, your risk tolerance. For most investors, I think it's smart to balance VGT with something more stable. In my case, I pair it with SCHD. A 50-50 mix of VGT and SCHD has outperformed VU by a nice margin over the past 14 years, while also smoothing out the ride. If you're on the younger side, you can usually tilt more towards growth without the same level of value counterbalance. Because in your case, if growth crashes, that's fantastic. You're buying more shares with every dollar you throw into the market. But don't forget this one, the key is simple. Never panic sell, no matter what. Your belief in tech will guide how much exposure you want. For example, a lot of you ride the semiconductor wave with things like SMH. For me, that's a little too concentrated within a subsector of tech, but I have to admit, it's performed incredibly well. And some of you might feel the exact same way about VGT. You may prefer safer bets like QQQM and SCHG to get that multi-sector broad coverage of growth. And there's no right or wrong here. It just comes down to your preferences and how you want to express your belief in tech. Personally, as many of you know, I'm a tech bull in all markets. Tech usually ends up being the next big thing, but I'm not smart enough to predict exactly where that's going to come from. Semiconductors, AI now, things like that. I prefer owning the entire tech ecosystem and letting the winners rise naturally inside the ETF. Whatever you choose, just make sure to balance out the rest of your portfolio with things that help you sleep well at night. You can always pair VGT with a value ETF, or you can just roll with something like VU, chill, and relax. Never get too high or too low on any one type of investment. Play the long game, stay consistent, and you'll win. And here are some more winners to throw into that mix. A huge shout out to my channel memberships for making videos like this possible. I appreciate the support that you provide. And while we don't have any new members to shout out in this one, I really appreciate all of you longtime OGs. And check out one of these 2 videos to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you in the next one. Peace.